If you're not a terrible person, we are happy to chat with you. If you have the wrong or no advice, or you have someone who isn't actually 100% looking out for your best interest, you can be pegged to the loser. Wall Street, they think of Wolf of Wall Street specific. We gotta sell off these shitty penny stocks. Because if we don't, we're stuck with the bill. It almost feels like that should be illegal.
I fully agree. I mean, that's how the industry was. There was no other option. I'm a reformed broker, so I know what it was like. There was a commission up front of 5.75% for selling an investment, and that came out of the client's account immediately, every time.
But we're talking about this is something today. This is how it is now.
Yeah. It definitely still is a thing.
Let's be honest. Yeah. The average person has no concept of what you're talking about. They know that they are words in the English language. If you were to try and take this and translate it into Desperate Housewives English, do you know what I mean?
Yeah.
So in a 24-year period, 25 to, what's that? Not great at math, 49, right? By that time period, your money doubled means the world. Yeah, it's a difference what? Like, let's say you were going to have $500,000 versus $1 million, 2 million versus 4 million. One, this is not more work for you. This is the work that your investment guy who manages your 401k or your IRA or your investment account should be doing. This is not work your HR is even qualified to do, let alone is going to do. If you've made it to minute 56 and you're a shitty human being and you have a shitty HR, then I'm sorry, you, my friend, have wasted your time and you are not welcome to work with Jason and his team. Let me clarify here. To your point, anyone who's watching this, and we will make sure to put this at the very beginning of this video, this is not tax advice, investment advice, any kind of advice. For that, we would have to understand intimately your detailed needs.
That's right.
Risk assessment, do all of that. This is not tax advice. This is not investment advice. Play. Hello, everybody. Welcome to another episode of Knockin Hard. And today I am joined with a special guest and partner in crime on, one kind of very important aspect of our business, and that's Jason Park. Jason, hello, sir.
Yeah, thank you. Hello, nice to see you.
It's a good topic that we're going to talk about today and really touch on something that it's a problem for a lot of small businesses. So why don't you assume that someone's hopping in here and they don't know who you are. Maybe they don't even understand anything having to do with investments. But yeah, investments is maybe the wrong way to say it. Company benefits having to do with investing. Where's your background? Yeah. What makes you special?
Yeah, great. I'm a financial advisor. So I've had my own investment firm for 12 years now, independently. Before that, I worked at a large insurance company. Before that, I had interned at Goldman Sachs Asset Management. This is back in Chicago, where I'm from originally. They were in the Sears Tower before they changed their name from Sears Tower. And before that, I actually interned with my father, who was also a financial advisor. This was at Wells Fargo. So like these big firms, and then I went on my own, and then I've been helping people independently for a dozen years. And a lot of my clients have businesses of their own. And I got to learn a lot about how the benefits mess is, and usually it's linked through their payroll. And I've learned a lot. And so I have helped my clients navigate through this and find usually almost always better alternatives. And that's what I do.
And here's the thing. Let's look at it from the perspective of a business owner. Let's say that some small business owner. It could even be a company of 25, 30. Some of these companies, because I sit with a lot of them, and people on the Forge team sit with a lot of them, and a lot of them don't have it, and they think that it's this unattainable benefit that they can't quite grab. And some of it I think might even be preconceived ideas, because some of them might be 4 or 5 employees, and they're sitting there thinking that, one, they don't have access, they can't offer any kind of 401k to their employees, and if they do, it's going to be crummy. That's really, it is interesting, but it is kind of I've heard it repeated so many times that it almost feels like a self-fulfilling prophecy for some of these guys as a business owner.
Yeah, I don't blame them. It is crummy. It's like a lot of things, how technology has really democratized a lot of things for small guys. It used to be where you had to go through just not even a handful, a couple of incumbents, and they're so clunky. The experience is slow. I talk to HR people and they hate having to like set up, administer, if they have to change something, like they hate the process of having to do anything with their 401k or their payroll. It's just a common complaint for sure. Technology has made it so that there are companies out there that make the experience very nice, like really enjoyable, like the UI, like the design of how the site looks, like the administrator is going to interact with that. Like it's very intuitive. It's very nice. So many times the HR person is telling me that they hate navigating the site, or even an employee who is a participant of the 401k, they go to the site to log on to see their account. It is so counterintuitive and it's not easy to find stuff. It's just that is the experience.
Yeah.
To make it worse, it's almost always more expensive than going with like a tech first 401k provider. And those exist now. And it's not like they're brand new. They've been around for maybe a decade or so. So they've proven that you can have a better experience. It's lower cost, and it doesn't have to be bad. That said, there are states that I know that require employers to provide a plan. And if they don't, that they have to enroll in the state plan. So I remember this from a client in Oregon when they were rolling it out first. Even if you have one W-2 employee, you have to offer a plan. Otherwise, you have to enroll in the Oregon state plan. Same thing for California. Same, like if you don't have one, you get penalized unless you enroll in theirs. But the state-run program isn't that great. It's not even, all it is a Roth IRA for the employee. And the costs, there are hidden built-in costs that employers don't look for and find. And while, 401k is a much more robust plan, and so therefore it is more expensive than the state-run thing, the benefits that you get by giving these benefits to your employees are much bigger. And the top execs, the owners, are the ones who benefit the most from these plans anyway, because ostensibly they're going to be the biggest participant in their own plan.
Right.
So this whole industry is kind of convoluted, and I think maybe intentionally made complex, but it isn't.
Yeah, well, and we've seen it. We see it a lot. The market is driven. There's no winner without a loser in a lot of cases, especially in the market, right? The market kind of depends on someone else to lose money in some cases for another person to win. So it is one of those situations where if you have the wrong or no advice, or you have someone who isn't actually 100% looking out for your best interest, you can be pegged to the loser. I know a lot of people think of they think of the movies, they think of Wall Street, they think of Wolf of Wall Street specifically, where they're like, okay, right, we gotta sell off these shitty penny stocks. Because if we don't, we're stuck with the bill. They're stuck with the loss because they're like, we know this thing is going to go down. And they're pushing one particular piece of the market or one particular stock or one particular falsely stated, great portfolio add-on. And it almost feels like that should be illegal.
I fully agree. I mean, that's how the industry was. There was no other option. There are two different types of licenses that a financial advisor can have, basically. And one is a broker license, and that's all there was. That's what all the big banks hired all the financial advisors, and those banks required that their advisors become brokers. And so a broker earns money by selling. It's a transaction-based incentive plan. So if they don't sell, they don't make any money, which obviously has a built-in conflict, because what if the client doesn't need to buy that thing? But if they don't buy the thing, then the broker doesn't put any money in his pocket. So he's incentivized to continuously sell.
No, hold on, wait a
That's
second.
how it was.
That's not the way I actually understand that is going to be the concept that I think a lot of people think. They go, well, I just pay my fee. I just have a yearly fee. What you're describing is like a fee at sale. And
Yes,
like what,
that's
it's like
right. That's
1%?
right.
1.5%?
No. It was like I'm a reformed broker, so I know what it was like. There was a commission up front of 5.75% for selling an investment, and that came out of the client's account immediately every time they bought. And that's the broker world that is.
But we're talking about this is something today. This is how it is now.
Yeah. It's still a thing. It definitely still is a thing. Now the other style, the other license of an advisor is not that. It's usually an annualized fee. Sometimes it's like per hour or retainer or whatever. But there's no more incentive or commission tied to a transaction. So there's no upfront commission when you buy something. Instead, it's a fee for advice. Like what you would imagine a financial advisor advising. Like you expect the advice, you pay for the advice. And it is usually linked to the amount of money that they help manage for you. And yeah, it can be as small as, well, I don't know, the average might be like a % per year or something like that, broken out into quarters or monthly. So much different from like an upfront 5.75% commission.
Where they really want you to have your money moving. At the end of the day, then.
They have to, right? The broker has to have your money moving.
Doesn't that also have negative tax consequences, though, in some cases?
It certainly can, especially if it's in a non-IRA. Right? Absolutely.
Let's be honest. You're saying IRA. I know that you mentioned earlier Roth. You're mentioning 401k. Let's be honest. Yeah. The average person has no concept of what you're talking about. They know that they are words in the English language, but that's it. They're like, yeah, that is English. He's speaking English. This is good. At least its subtitles are on correctly, but that's about it. There's not like hey, yeah, I intimately understand what he's talking about. Understanding is gone. So if you were to try and take this and translate it into, hi, Desperate Housewives English. Do you know what I mean?
Yeah.
I don't know if that's a term.
I mean,
maybe just coin a new term. Desperate Housewives English.
I can roll with that.
Cheers with my
for
Stanley.
Sure. Like 100%. So yeah, there are only 3 types of accounts which are taxed differently. There's 3 different ways accounts are taxed, depending on what type of account. So an IRA stands for individual retirement account. Individual meaning like only one person can own it. So if you and your spouse want to own your IRA, you can't. It has to be one person owning it. Retirement, it's designed for retirement and it's an account. Great. So an IRA, there's 2 kinds. A traditional IRA, which is pre-tax. That means the dollars you put into a traditional IRA, you get to deduct the contributions from your taxable income. So you don't pay taxes on those dollars that go in. So there's the benefit in the current year that you contribute. That said, you will have to pay ordinary income taxes, which are the highest rate of taxes, on every penny in that account. Even if you don't want to withdraw from that account, the government forces you to make withdrawals. And this is later. The age now is like 73. It used to be like 70 and a half and 72, 73. So once you hit 73 and every year thereafter, you are forced to withdraw a minimum amount, even if you don't want to or you don't need it. And that's because once you withdraw, you have to report that as taxable income. You have to pay ordinary income tax rates on it. So let's say you're in the bracket of 22 or 24%. That's these days, right? So it might be higher later. You're going to have to pay that. So that's a traditional IRA pre-tax. Then you have a Roth IRA, which is the flip. The money you put in, you don't get a deduction for the contributions, fine, but all of the growth.
Why is it called
is
Roth?
tax-free.
Does Roth stand for something?
It was a guy's name.
Okay.
It was a guy's name.
Okay,
And
yeah.
he was like, yeah, this is a cool account.
Yeah, let's do that.
It's funny,
Great.
like if you interview the guy, yeah, he's got some interesting things to say about like how it's become wasn't actually what he intended. Anyway, it's like some nerdy stuff. Anyway, Roth IRA is the flip. Money goes in, you don't get a tax break when you contribute, but all of the growth is tax free forever, basically. Like it doesn't matter if the account grows by double or triples or 5x's or 10x's. It doesn't matter how much it grows. You never have to pay tax on it when you withdraw. There are some rules for both of these, right? But this is like a general concept of the difference. Even if you pass away and your beneficiary inherits your Roth, they don't have to pay tax on the gain.
Wow.
It's very, very cool. Like, so the trade-off is great. Is it worth it to me to get the tax break to deduct the contribution in the tax year I'm in, which would be pre-tax or traditional IRA, because I'm in such a high tax bracket? Maybe you're in the 30s. Maybe that makes sense. Or is it worth it to me? Fine, I don't get the tax break, so I have to pay taxes on my income, because you do. But then forever after, it's tax-free. That's amazing.
Let me also just, it's so funny. This is terrible. This is going to be, here, I'm just going to get this off. You're going over this, okay. And even part of me, and I've been in this industry, part of me goes a little glossy. Because let's be honest, you're talking about, no, but here's what I mean by that. I'm like, yes, I understand what you're saying. I do get this. I get this. But at the end of the day, you are talking about math and taxes and decisions. And are you telling me that like someone has to sit there, like someone who's working with you, are they sitting there going, okay, well, I have to decide, do I use IRA? Do I use Roth? Like, do I have to pick one? Can I have both? What's the consequences here? Like, that's where I think a lot of people go, is they go, overwhelm, does not compute.
I mean, I guess I could say some general rule of thumb. This is not advice.
Let me clarify here. To your point, anyone who's watching this, and we will make sure to put this at the very beginning of this video, this is not tax advice, investment advice, any kind of advice. For that, we would have to understand intimately your detailed needs.
That's right.
Risk assessment, do all of that. This is not tax advice. This is not investment advice. Play.
Okay. General rule of thumb. I think if you're in a lower tax bracket, and right now we are in a historically very low tax environment. Like if you ask any CPA tax preparer, look at the history, we are very low right now. Fantastic. If you're in like a 22, 24% bracket, a 24 bracket is very, very generous. It's a very large bracket. And if you feel, yeah, that's a pretty low tax rate, then great. Don't contribute to a Roth. Yeah, and then just enjoy the tax-free growth. Generally speaking, that'll be good. Generally speaking. Obviously, if tax rates are lower in the future, then no, that wasn't the right move. But I don't know. It's historically low right now.
Yeah. I saw something along the lines of like, we're 112 or 113 years of having income tax, and 74 of those years, or like 75, something in the 70s, 70 of the years have been higher than they are now. Meaning like, that's like, call it 75% of the years that have existed, that income tax has existed in this country, it's been higher than it is now. So you look at that and great, more math. Look at Curtis throwing probability out here. But like, more than likely it's going to be higher than it is now, because that's what it's been.
That's right. So what's cool about 401ks regarding these types of, well, we've covered 2 out of 3, so fine. Pre-tax and Roth. Those are like the 2 categories.
Yeah.
It's the same thing for 401ks. Nowadays, most 401ks offer both a pre-tax portion and a Roth portion. It's built in. It's the same. They're not technically IRAs because it's a 401k account. Right. Fine. But
and 401k means what?
Of money. It's like the number of a tax code.
Oh, okay. So it's just like you fill out form W-2.
It's an employer plan.
Same concept. It's like a
yeah, sure. Think of it like that. It's just the name of it.
Cool.
So I mean, there are different kinds of accounts depending on what kind of company it is. If it could be a 403B, it's a similar type. 457 is a similar type. So just within this world, there is also pre-tax and Roth. Beautiful. If you have an option, and again, if it's worth it to you that, yeah, I'm in a low tax bracket, it's worth to not get the deduction of contributions in this year, and you want to put your contributions into your Roth 401k, and there's a match. Usually there's a match. The employer match is always pre-tax, always, because that's how they get their deduction.
They're taking the deduction.
So you're always going to have, that's right, you're always going to have a pre-tax portion if there's a match and you contribute. If a person listening is like, okay, I have a 401k, maybe I should look and see, do I have a Roth portion? And you do. And if you want to funnel all your future contributions that way, that might be a good move, because again, your pre-tax account is gonna be taxed at the highest rates, which are ordinary tax rates, whenever you pull the money out.
Okay.
Even if you don't want to, you're gonna have to pull it out.
Yeah, and that's gonna happen no matter what. So I guess here, this is because you and I have obviously talked about this off camera a bunch, and I've learned a lot from you on the dirty little secrets of the industry, but also some of the things that can be done that are great. And let's also call a spade a spade. The people that we're most likely talking to, just even based on the kind of individuals that are watching this podcast or seeing little snippets, they're business owners, or maybe they might be the HR, but in a lot of cases, they're either looking at, hey, how can I add this to my company? Or they're looking at it going, I already have something, but yeah, those broker fees, I definitely have seen them and I've wondered what the heck they are. So the $1 million question is, just because I know we're still talking about this particular point of the difference between Roth, 401k, IRA. I know that there's something, especially for the higher income earners in a company, which, hi, Mr. Business Owner, this applies to you directly. Is there a simple way to define and also explain this concept of location? I know it sounds like, it's where you are.
I love that. I love that.
You're sitting in a chair. Location as it relates to what we're talking about here.
Yeah. Okay. So I think a lot of people may have heard the term asset allocation, right? So this is just simply what investments you choose. And that should be based on your own risk level. So if you're very aggressive, then your asset allocation might be made up of a lot of more aggressive investments. It's the right mix, because you can have aggressive and conservative and whatever percentages. Great. Then asset location is this idea that you put the right investments inside the right accounts because they are taxed differently.
When you say accounts, you mean Roth, taxable.
Yes, exactly.
And okay.
Exactly. So we've talked about the pre-tax traditional IRA or the pre-tax 401k portion, same type of money. You have the Roth IRA or the Roth portion of the 401k, same type of money. And then you have just everything else. We'll call it like non-IRA. Non-IRA money is taxed a third way, a different way. If, generally speaking, if you hold on to something for a year and a day or more, and there's gain, and if you sell it at a gain, you have to pay taxes on the gain at a better tax rate, capital gains, long-term capital gains rate. So, and those rates are lower than ordinary income tax rates. So, fine, 3 different ways of taxing. And because of the 3 different ways of taxing, asset location, the idea is you intentionally put the right things in the right account. So if we know that, let's go pre-tax. A pre-tax account is gonna be taxed at the highest rates at some point. Then maybe instead of putting your aggressive things there, which is just going to grow the account, like stocks are generally more aggressive than bonds. Yeah, Stocks are like pieces of ownership of a company, and bonds are like you're lending money to the company. So that's a very, very generalized comparison. Stocks are more aggressive. So if you want to, but then within the stock world, there's
meaning they potentially make or lose more money is the way to look at it, right? Or they grow or lose more value potentially than a bond would. So that's why you say aggressive, right? Okay.
Exactly right. And even within that category, there's lots of subcategories, like small company, large company, where in the world the company's located. Like you can you can slice it up in many different ways. If you put aggressive investments inside a pre-tax account, traditional IRA, traditional 401k, then you're just also growing your tax bill. And there is no escaping that. You have to pay that tax. So, okay, so maybe you put your conservative holdings into your pre-tax account. Yes, obviously the overall intention is to grow, but if you're going to hold conservative things anyway, put it into the account that's going to be
trigger the most taxes.
Tax.
Right.
Exactly, right? And so the flip side, the Roth, we know is tax-free. It doesn't matter how much it grows. So that's where you might want to put your aggressive investments, because it doesn't matter. You want it to go like to the moon and no taxes.
Why have I never heard this concept though? Why is this like a concept? You know what? Actually, sorry, I'm going to hold that question. Give the third thing, because I want you to be able to give the full concept here. Go ahead. Sorry, my apologies.
Yeah, I mean, the third thing was just that third type of account, which is like you only pay taxes on gains if you sell things that you've held for a year and a day or more. Fine. That's like a third type of account. This is actually just money, like your bank account. If you have a trust that holds money like that, or what's called a brokerage account at an institution, financial institution, those are all the same. They're all just non-IRAs. They're all taxed the same.
They're not your retirement accounts.
Correct. And so that would be like the catch-all. Whatever's left over, whatever the right mix is left over, that's what you hold in that account. And so, like, let's say the asset allocation that's correct for you is like a 60-40 stock bond split, let's say. So a very easy, lazy, conventional way that an advisor might suggest is like, okay, 60-40 for your pre-tax, 60-40 for your Roth, 60-40 for your brokerage non-IRAs. Obviously, then as a whole, it's 60-40. But doing asset location, you might intentionally put it might be like 20-80 in your pre-tax, 100-0 in your Roth, and then like 50-50 in your non-IRA. And each one looks totally different, but that's intentional. It's by design. But as a overall, it's still the 60-40. So it's just it's like another benefit you get that doesn't alter the overall allocation. It doesn't alter your risk. It just takes some work to do. And maybe that is why you haven't heard about it. Like, it's not a new thing either. It is a thing. I have never met a new client who had an advisor that they did that for them.
It almost sounds like, Jason, you're describing the traditional process in the industry, what most people are actually getting, as two-dimensional investing or playing traditional chess. And what you're playing, I hate using it, so cliche, but it does feel like you're playing three-dimensional chess. You're adding an entire additional dynamic to investing. Yeah, an entire new dimension, and like a dimension like, I'm sorry, but the two certain things in life are death and taxes, right? Well, you're manipulating the taxes to your advantage.
Yeah, totally. And it's free. It's not like it's something you have to buy to do this. It just takes time and calculating. And I thought, I thought there must be some kind of software calculator that was already built to figure out, like, okay, what do I put into each account for asset location? And I looked and it didn't exist. I was very surprised. So I had to build out my own calculator and so you just plug in, like, all right, what are the values of all the different accounts? And there's lots of rules and formulas, and it just spits out right away, like, okay, this how much in this type of investment in this account, this much in that account, and this, to the penny. It is nice. And if you have, a lot of times 401k plans, if they do offer both pre-tax and Roth portions, when you make your choice of how you want to invest, like your allocation, they make it so that there has to be the same allocation for pre-tax and the Roth.
Oh, wow.
You can't divide it and make, no, I want my Roth to be aggressive and I want my pre-tax to be conservative. A lot of times they don't. They just,
is it just lazy?
Doesn't let you.
Is it just laziness?
No, well,
or in design?
I don't know.
In that
Maybe
case,
I'm part of the company. I just don't know why the limitation exists in some of these companies' offerings. but it's too bad. And actually, that's not even just the incumbents, not just the old legacy 401k providers. I know of a new one, relatively new one. They don't offer that.
Wow.
But yeah, so like we partner with, as an independent, like we don't work for any 401k provider. We don't work for a bank. We don't work for a financial institution. We work for the client.
Yeah.
And the only one who pays us is the client.
Well, it's good because
our,
that's like a very important point. Like we all know this. Like you go to a restaurant, and I think I used this example, or I think it was in a previous podcast with Jack. But if you're curious who the waitress is going to take the best care of, it's the person paying the check that they look at and they go, yeah, daddy's sitting at the end of the table. No question, he's got the check. Who's going to have their water refilled the most? Well, the question is, do you want, you know what I mean? Like, I know that sounds silly, but if you want to make sure your incentives are aligned, make sure that the only person that is guiding whether you have a good retirement or not has your interest and only your interests.
Yeah, 100%. And I feel like consumers, rightly so, would expect that or assume that all advisors do that or have a responsibility or duty to do that, but they don't. If you are of the kind that has the broker license, the one thing that I have prepared to like reference is this. This is there's a regulatory body for all advisors. It's called FINRA. It's a short for like Financial Regulatory Authority, something like that. Anyway, it's a quasi-governmental agency, and so they define what a broker is and what the other type of advisor is. So a broker, from their site, the official site, a brokerage firm is in the business of buying and selling securities, that's stocks, bonds, mutual funds, and certain other investment products, on behalf of its customer as broker, fine, the rest. Individuals who work for broker-dealers, the sales personnel are commonly referred to as brokers. This is their definition. The sales personnel, so they're salespeople, are commonly referred to as brokers. And again, they're in the business of buying and selling securities on behalf of its customer. And so that's how they get paid, is when they buy and sell. So that's broker. The other type of advisor that doesn't do that and they just get paid for advice is called an investment advisor. It's a different license. An investment advisor is paid for providing advice about securities to clients. In addition, some investment advisors manage investment portfolios and offer financial planning services. Great. So you can see that they're not sales personnel. They get paid for giving advice. There's a third thing to note, though, in this topic. If you have a broker license, if you have an investment advisor license, from their site, it is common for a financial professional to act as both a broker and an investment advisor. It is common because the majority of the advisors that get hired are from the big banks, and the big banks make you get both licenses. So another term for this is dual registered. You have both. So, okay, at best, that type of advisor who has both licenses, at best, they're not acting in their fiduciary duty. Fiduciary is a legal requirement to do what's best for the client, to put them first.
Right.
That is the level of duty and regulation that an investment advisor has, not a broker. So someone who has both licenses, they can, at best, they're not being a fiduciary all the time. And at worst, they're a wolf in sheep's clothing, because they can legitimately hold themselves out as, yes, I am a fiduciary. I have the license where I am the investment advisor, and then turn around and then
without disclosure, switch.
Yeah, I've seen it, and so that's not cool. So yeah, I had both licenses. You know, I came up in this industry just like everybody else, and then I let my broker license expire, and I celebrated it because it gives me there's no restriction that I have having just my fiduciary investment advisor license. I guess the only thing is like I can't make commission if I sell something, which is what I wanted to get rid of. I wanted to get rid of every kind of conflict that could possibly arise. Yeah. There's no perfect system. I just think this is more perfect than this other old way.
Well, I understand that too, because I can kind of relate that in the way that we handle the benefits on the health side, because you'll see there's a lot of health benefits. There's two worlds. There's percentage and then there's fixed. And the percentage benefits by prices going up. So, hey, so sorry, we shopped around, but your rate's still going to go up 5% this year. Well, guess what that means? I just got a 5% pay increase. So the incentive to find you the best deal, the incentive to keep your rate low, and trust me, especially this last year, we've seen rates go up by 30, 40% versus per employee per month, a fixed dollar amount. And that is the way that we actually operate on all of our group business. And that is, no matter what we're selling, it's the same exact money. And across any and all carriers, which makes it so at the end of the day, our job it makes our job a lot easier if we can save you money, because then guess what? You're less pissed off at us. So I understand the philosophy. It's an important distinction. So another thing that I think that is worth noting here, because some of the things that you're describing, like you've said this a couple times, quote, it's just a little more work, or probably that's you being a little bit, I'm trying to think of the best word. You're choosing your words wisely. I'm sure in many senses it's a lot more work, depending on how many people So the question
especially
is
in the
this.
beginning, trying to set this up, it was a tremendous amount of work. It was a lot of investment in just trying to build out the calculator, and just like the moment I learned about this concept, it's like, well, as a fiduciary duty, I have to now provide that service to everybody. Knowing it and not doing it is not right.
Violates the definition of being a fiduciary.
Absolutely. And it's not like I charge for it or raise rates or something. It's just there's something that will give a benefit for the client. So I will do so for sure.
Yeah. And I know you've mentioned this point. No, it's totally fine. I know you've mentioned this point that there are studies that have been done over the course of 20, 25 years that point out kind of some of these points. Like if your investment advisor or whoever's acting to manage your account, your 401k, your IRA, whatever it is, and guys, people listening to this is for you personally, but also for all of your staff. And guess what? If they're sitting there going, yeah, it's so weird. I'm working with XYZ company, and now all of a sudden my returns year over year are just for some reason better, and the guy that we're working with seems to give a crap. Those things make you more sticky as a company. So here, little side note to think with there. But the other point of this that it makes me ask, because let's be honest, people are going to ask this. Are some companies too small to have access to some of these strategies?
Oh, I see. No, not anymore. Like there's been, because like technology and all that has come about, and like there's these newcomers. They're not new anymore. They've been around decades, I guess. Some of them, they've come in technology first, and so they don't have all of the clunk and cumbersome processes and platforms that all the old large legacy providers have, and it's made things so much nicer, and usually it's cheaper. Even if it's just nicer, it is almost worth it. If it's the same price and it's just so much, like the user experience for both the HR administrator and the employee, the participant, it's so nice and so intuitive. It is just worth it. It's just worth it to have such a nice experience. And it's usually cheaper anyway.
Wow.
And yeah, you can get all the benefits of like, the low cost, basically getting rid of all the conflicts of interest. You can separate out the allocation, your pre-tax Roth, your pre-tax from the Roth portions inside the 401k. So you can do actual asset allocation. It's really nice nowadays. And
interesting.
It doesn't matter the size of company. I think it's become, the small guy was forgotten about because they're not as profitable for these companies, but that's why this industry boomed. This tech forward, tech first financial companies, they came out and provided an amazing platform, and it's really nice. I've yet to meet anybody who didn't like the site or the app on the phone, compared to the consistent complaints I get from clients who still have to log on to their, I can't mention companies, but like their employer's 401k plan site. And even when they like show it on a screen share, because we're trying to look for something,
Shifality,
I'm
right?
trying to like navigate. Yeah.
It's just this random set of sounds that came to my mind.
That's right.
Sounds
That's
similar
right.
to and or like companies located in the greater Boston area.
Yep.
Sorry, carry on.
It's
I got
really
sidetracked
hard.
there.
Sure. Like as a fiduciary advisor, I'll help a client. I'll help them with their existing 401k. It doesn't mean that like I have become the advisor of that company's 401k, but I will help them. So they'll try to like find something, they can't find it. They share their screen, and I'm trying to like, okay, click here. Oh no, go back. How about here? Click there now. No, that's not it either. Oh, I remember. Go here. And it's like we have to do a flow chart for the next time we log on to remember like how did we get to that point? It's so clunky. Yeah, it's really. I think I just have short patience with that. Because things don't have to be complicated. They don't. And things aren't complicated, actually.
Well, it's important too.
Yeah.
And I know that this is an important distinction because there are, I think it's the Swedish or it's another country, top of Europe, that it's the opposite of here, where you check a box to not participate in their equivalent of a 401k versus here you check a box to participate in 401k. That little thing completely inverts the percentage of people participating from that country to here. And it's the same thing. Like, I'm sorry, but if something has friction, guess what? Adoption isn't there. If they go in and they go, God, I can't even find where to put more money. They're just not going to do it. And guess what? Those small decisions result in someone who gets to retirement and they go, well, would you look at that? I can't retire. And it's, you and I both know this, and I'm sure a lot of people on this call know this. A company and an individual spends every penny it makes. And shockingly also, they spend money on things that at the end of the day don't actually really change their quality of life and don't actually make it so all of a sudden they're that much happier. And if they hadn't bought that, well, you know what? Darn. Guess what? That the immediate gratification does not outweigh in many senses, nor change your life enough to result in the things you might lose years and years down the road. But you've got that, and then you've also got what you lost because the person that you trusted to manage your company's 401k or your own individual accounts, is that a real quantifiable change? The things you're doing, taking kind of those broker fees out of the equation, does that make a notable difference when someone goes to retire?
Yeah, for sure. Those are the studies that you've alluded to me sharing with you in the past. Yes. It's like, it is so unnecessary and sad. Like so many participants, maybe they didn't enroll and they could have, or they just haphazardly chose some kind of allocation, which may not actually be correct or appropriate for them. Like I've had people who basically are in cash positions inside their retirement account and then just don't do anything with it.
Wow.
And don't look at it for years. And it's like such a waste. It's such a waste. And it's not like they chose to just put in cash. They just didn't know. They just did some process on the website. Like there's a lot of times they're not, or they're not contributing as much as they could. If there's a match, or even this. So even like the Roth portion is such a nice type of account. Either one actually, pre-tax or Roth. The limits of how much you're allowed to contribute into your 401k accounts is much greater than your limits on contributing to your IRA accounts. So people don't even, a lot of times they don't know that, and they just put in just a little bit when they could afford to, but didn't know that they could have done, I don't know, 3 times, 5 times that. It's like a big difference, especially since time is on your side. The longer it gets to stay working for you, the compounding effect is tremendous. And so it is sad and like not cool.
Yeah.
That, like, nobody obviously guided them to like, wait, maybe you should contribute to your Roth instead of your pre-tax, and maybe you should do allocation this way, and maybe you can contribute more, or it makes a big difference, especially over time. And so, yes, there's this one major company who's been doing this study for the past 25 years. There's other major companies. These are investment firms, and they've tried to quantify how much additional net return does an advisor
What's a
bring
net return
to the client, like after fees, including like everything, right? It's not just a nice to look number, but it's a real in real life number.
Right.
So how much additional
What can you actually
return,
spend?
how much additional percentage? Yes, that's right. And so there's like a list of things, one of them is asset location. One of them is that. And so it's like, if you, not even if the advisor does this, if you on your own do these things in your accounts, then at the end, the sum total, it says, they're all about the same. These different studies, they say about it can be an additional up to or even exceeding 3% of additional return per year.
Per year. Wow.
So yeah, that's right. So that's like, okay, well, if I'm not doing these items, then I'm losing out on the 3% I could have or should have gotten.
Wow.
And so, yeah, it's like it legitimizes advisors who do those. To be clear, if an advisor actually does those items, those actions,
Important caveat.
then yes, an advisor could and should, and you can expect an additional 3% return on your accounts. And that's not insignificant. So yeah, I've seen it a lot, and I don't know. People
and
are
here
good,
I'm gonna
and they deserve the help.
100%. And I want to actually highlight something to point out here, because I think sometimes people go 3%, whoopee. There's a basic rule that's kind of important here. It's called the rule of 72. You basically take an interest rate, you divide the number 72 by that interest rate, and it tells you how long it takes for your money to double at that interest rate. So if you're talking about 72 divided by 3, this doesn't seem that crazy, but like, let's say you've got, or you yourself are 25 or even 35, and you're sitting there going, yeah, I want to be retired by 65. If you're adding an additional 3%, okay, you're adding, because these actions are being done, 72 divided by 3. Okay, we're going to test the capability here. Can it capture and focus on it? God bless America. There we go.
24? Yeah.
24. So here's what that means, though. Find me again, camera. There we go. What that means is that in a 24-year period, your account will be double. So in a 24-year period, if you're 25 to, what's that? I'm not great at math, 49, right? By that time period, if you get that extra 3%, your money doubled an additional time. So 3% means the world. It's the difference.
I mean,
yeah, it's a difference. What? Like, let's say you were going to have $500,000 versus $1 million, 2 million versus 4 million.
That's right. I mean, also, if you look at like, okay, if on your own you were making 6% or something like that, right? Based on that rule, that's 12 years to double. But if you're making an additional 3, you're making 9%. That drops it from 12 years to doubling to 8 years to double. Like,
that's right.
Yeah, it's not insignificant. And again, like with compounding, and you have a long time. Even retirees have a long time still. They have decades still. So yeah, it's not necessary to have these inefficiencies inside the 401k accounts. This goes for every participant. And I think especially for the employer or owners or top executives, the higher paid, the higher compensated employees, because they are the ones who can take the most advantage of their plans. Like the
Yeah.
biggest accounts are going to be the guys at the top. And
Can I
so
also ask a
it is a
question?
direct,
This
yeah.
violates every rule in the book that I actually know of for me to ask this question. Don't worry, it doesn't violate your
Yeah.
rules. We're not touching on SEC or FINRA
Okay.
violation. No, but what is the, because it's a company 401k. Does the company also have that same sort of fiduciary duty?
Oh yeah. Yes. By the way, yes. The provider, the
Sorry,
person who's
guys,
gonna
everyone
offer
who's
this plan,
hearing this, guess what?
yes.
You now know.
Yeah, you do. You do. Actually and technically. It is true. So I don't know. At minimum, you should be shopping around, I guess, like to get different quotes. It's a pain. No HR person wants to do this. Like it took so much time and effort to set up the plan that you already have.
Yeah,
And you've already made a big decision on the payroll provider
yeah.
because 401k plans integrate with payroll providers. And it's like such a pain to change. I get it. But if the transition is over to a much, much simpler system, much nicer experience, far less complaints, much more user adoption, you're going to have happier employees, like you had said, they're like stickier. Like, if the intention, I know the intention was good, is to offer more benefit to the employees, actually allow them a higher chance to take advantage of those benefits by having a much better system, a much better experience, an easier way to do so. Like a few clicks on a very intuitive site or an app on your phone, just a few clicks and you can make these adjustments. Like, yeah, I wanted to do asset location. I'm going to go more aggressive in my Roth and I'm going to go more conservative in my pre-tax. And yeah, I can make adjustments on where my future contributions go. I'm going to make changes on like how much. It'll notify me if I'm hitting my limit. I mean, that's a common thing, but in a very, very smooth, designed way. Like it's very nice nowadays. We are very spoiled in my industry. This might be the golden age of financial advising. Honestly, with all the tools that we have, it has never been easier. Before, like Wolf of Wall Street, as they depicted, you just needed a phone. You need a phone and list of numbers, right? Now you don't need an office. You just need a laptop and a phone. And it's not just selling penny stocks. You're able to do sophisticated financial planning, make very complex adjustments to very big plans. Like it's so nice now. I think it's just a shame to not take advantage.
And when you say you, I want to make clear that means you as the advisor versus, because one thing I don't want to ever have someone get the wrong idea of, because I've seen it. I've met with so many people in HR. It's not that they're work averse. They're usually way understaffed. And
Yeah,
they're
are they
like
stressed?
Yeah, it's the most amazing thing. And it's not like, hey, why didn't you do blah? Well, because I should have 3 more people in here based on the staff. And so I want also the HR or the company owner to recognize these important points. One, this is not more work for you. This is the work that your investment guy who manages your 401k or your IRA or your investment account should be doing. This is not work your HR is even qualified to do, let alone is going to do.
That's right. And I think if you have a 401k right now, you are assigned some person, a live person. But the people, like my clients, I have a very good friend who was also a client, and she was a HR benefits person for her large company. The person never came around. He did a webinar once and like had people, in an office, like on the screen, and like people were falling asleep, really bored. It's like not helpful, it's not a good.
Well, and it's important to cover the terms too. it's important to cover what is this stuff, because, let's face it, it's these technical, financial, health insurance, insurances in general, they are made intentionally complicated because they want you to get glossy. They want you to have no idea what you're doing and have no ability to track, because not everyone in the space has your best interest. And also, you know how the easiest way you can tell that is for the same action in bonds versus stocks versus things like futures. The same action is called three different things, meaning they just add extra terms just to make it so you have no way to follow. So that's why
crazy.
It's insane.
Bonds
Absolutely
are also
insane.
fixed income, which is also debt. It's like,
you're like, what?
why?
Huh?
It's not necessary. It doesn't have to be complicated.
Yeah. Well, and it's important the advisor that you're working with darn well better be advising you, because otherwise, it can result. I've seen accounts in the past of clients, because they know that I'm in around the industry, and they show me stuff and I'm like, whoa, like this needs to be looked at bad. So here, I guess call it. I'm not a fan of podcasts that go longer than an hour, because let's face it, nobody's got attention units for that. Shoot, TikTok, we got attention units for like the 30-second clip, if that, the 15-second clip that we'll cut you into and feed to people. So the question again, and I know you've already said this, but I want to make sure now to reiterate this point, because we've talked about location versus allocation. We've talked about all the massive difference that a small number like 3% more a year can mean. And this is something that you do for clients, companies of any kind, any size. Like, is there someone who is getting to the end of this hour podcast who you're like, sorry, I don't work with you? And they're like, shoot, I just wasted an hour of our time. Like, who do you not work with then?
Who do I not work with? I mean, I might be spoiled and maybe I come off a bit snobbish by saying this, but I have the luxury. I'm very blessed that I get to choose who I work with. Like when I was working at a bank, you can't not work with the client who was given to you. That you have to service the client, and they usually come from the bank side, which is why the bankers or the tellers are always like very interested in talking to you when they see you have a big deposit or something, or a big sum of money in your bank account. They're like, wait, I want to set an appointment with an advisor, because they get a commission or kickback by referring over. So then you get referred a client from the bank side and you're the advisor. You have to work with that client. You can't refuse them. Just as much as a potential client is interviewing me, I'm interviewing them. Most people are great. Most people are awesome, nice, kind, just trying to do better. And so, I just work with people who are that way. So that's really it.
If you're listening to this podcast and you've made it to minute, here it says 58 minutes, but I don't know. I feel like maybe there was a couple minutes of talking before that. So maybe it's like, if you've made it to minute 56 and you're a shitty human being and you have a shitty HR, then I'm sorry, you, my friend, have wasted your time and you are not welcome to work with Jason and his team. If you're not a terrible person, we are happy to chat with you.
Yes.
Okay, but here to reiterate this, in terms of minimums though, like it's not like, oh, you have 2 employees, we won't work with you.
No. We'll work with you. It's totally cool, especially if you're in a state that you're required to provide something like this, or if you're using the de facto default state plan, and you want to actually provide much better benefits to your employees. Yeah, great. It's all good.
I love it. That's amazing. Mm-hmm. Well, here's the thing. I think that there's a lot more that could be unpacked here. But at the same time, I wanted to make sure that we got something taped and, in the books that someone could get just a general idea of like, oh, there is something better here. And I think I think honestly, I think we did a good job of that. And I hate to say it, but
I don't know. I hope
you know,
so.
if they're a shitty person, then no, we've established that. Then they've totally wasted an hour of their life that they will never get back. My apologies. But other than them, I feel like this will help someone navigate the world and know, hey, yeah, your account with your 401k, or sorry, your account with your bank or with your, your payroll processor probably isn't necessarily going to result in the highest return, the best experience, and it might be best to look for something else.
Yeah. Yeah, well said.
Awesome. Well, thank you again for your time. And for anyone watching this, obviously subscribe, do all the normal social media, YouTube thing that you got to do, and share this with someone you know, because here's the thing, good friends don't let their friends have crappy 401ks. I don't think it could be stated
That's
better.
a good bumper sticker.
It's a bumper sticker. That's right.
Yeah.
Awesome,
Love
Jason. Thank you so much for your time. And I guarantee we'll do this again.
My pleasure. Thank you.
Of course. Take care.